This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
This week, it all comes together as we talk about how AI will solve inflation and probably take your job on this week's Wise Investor Show podcast. Welcome to the Wise Investor Show podcast, broadcasting here from the surface of the sun. I'm Chase Hinderstein, and it's a fine day to be in a radio studio. We're closing in now on the first half of 2024. It is just about the longest day of the year, and so far, the Dow Jones Industrial Average is up 4% for the year. Equal weight version of the S&P 500 is up 5%. And the NASDAQ, the tech-heavy NASDAQ, up 18%, while the traditional market cap weighted S&P 500 that so many use as the benchmark, it's up 15% for the first 6 months of 2024. And with the federal holiday this past week, the biggest economic data point was the release of the May consumer sales data, which came in positive year over year. Is actually a bit below forecast, but an improvement over the prior period in April when it was negative 0.2% for the period. And, we here are in no particular rush to invest directly in consumer-oriented companies, although we do have some exposure there. But why this matters, of course, is to help speculate on the fate of the economy and monetary policy. And according to one analyst, actually here it's the chief investment officer at the Independent Advisor Alliance. Not quite sure what that is, but not to disparage them at all. I don't know what it is, but it's from a Wall Street Journal article. Quote, retail sales came in really light this morning, and while that might be good news for inflation hawks, it could be the beginning of a slowdown in growth, which would hurt a lot more than a couple of interest rate cuts would help, end quote. So the battle rages on here, right? Rate cuts now or later, and an economic landing comfortably or splattering all over the runway. According to another journal article back on June 16th, quote, investors look sanguine, and analysts say they have good reason. The economy has remained stronger than almost anyone predicted after the Federal Reserve began raising interest rates. Corporate profits are rising again. Inflation cooled more than expected in last week's consumer prices report. And Fed officials signaled that they expect to cut benchmark rates later this year, end quote. But continuing later in the article, part of the problem with a strong economy and calm markets is that they create an environment in which investors let their guard down and turn to riskier, more speculative investments in their hunt for fat returns, end quote. The S&P 500 would be down over the past 30 days if all the stocks were given the same status. If you use that RSP, that equal weight version of the index is down for June. Instead, the market-weighted index is up 4%. It's actually more as of today. The 10 biggest stocks recently represented, according to this, 36.8% of the index's total value, the highest in about 25 years, according to FactSet. You may recall me referring a few podcasts ago to a recent Howard Marks piece when he addressed risk, and this was part of it. Some investors, while fear risk, their level of fear goes up when it's been too long since a shakeup. Well, that's not a good approach. It's not a case of what goes up must come down. That's absolutely not true about the markets. Over 100 years, the markets have gradually climbed with some notable and at times prolonged steps back. But it's not a zero-sum game where everything ultimately returns to the same price. Until proven wrong, capitalism works and well-run corporations gain value over time. But that being said, if it's been too long since a reality check, since a bit of a shakeup in the markets, maybe not even a black swan event, but just a normal correction, hence the word, then you also may encounter elevated and even unsustainable valuations, which should make you wary. However, what all too many investors do in times like these, which is the point, these long periods without any reason for fear of losing, and what really only lingers is this pervasive fear of missing out, then too many investors forget and start chasing the risk and over-leverage to it. Why we don't buy the most overcrowded trades? Why don't we gravitate towards what has been working instead of what's been out of favor? Well, if you listen to the show, you can figure that out. But there is good news now. And the average investor isn't the only one sanguine out there. You can slap that label on me too. According to Goldman Sachs in their macroeconomic report this past week, quote, last week's benign U.S. inflation data reinforced our view that the first quarter spike was an aberration. Meanwhile, the labor market stands at a potential inflection point where a future softening in labor demand would actually hit jobs, not just open positions, and could therefore push up the unemployment rate more significantly. This is important, and that was the end of the quote. This is important. I had kind of mocked, I don't know if that's the right word, but made light of Goldman Sachs early this year, the end of last year, in favor of a more conservative projection by J.P. Morgan. Goldman was asking for 8 rate cuts this year. J.P. Morgan was saying, hold your horses. We're not sure we're going to get any. But now I'm kind of taking a more contrarian approach, more contrarian at least to the average consensus, and believing by looking at the data, also looking at the calendar, plus just reading what the Fed's telling us directly, taking it at face value and thinking we're going to get one, but that we could eke out a second rate cut in the latter part of this year. Goes along with what Goldman is saying as the report goes on with, quote, we thus continue to expect 2 Fed rate cuts this year in September and December, despite the hawkish June dot plot. This implies that core PCE will end 2024 at 2.7% year on year, a slight increase from May's estimated 2.6% because of adverse base effects, but slightly below the latest median FOMC projection of 2.8%. We still expect both headline and core inflation to fall to 2% in 2025. Okay, so that's Dullsville, but what they're saying is that most important reading of inflation they think is going to 2%, the Fed's ultimate goal next year, and they think they're getting 2 rate cuts starting in September. And I mentioned the calendar as one element of this kind of formula. There are only so many meetings for the Fed remaining, and the Fed can do whatever they want. They can cut rates on a Sunday. They can have emergency meetings. But short of any kind of real emergency, they have their scheduled meetings. And tradition and common sense suggest that they tend not to act right before an election. So that leaves us with one and maybe a chance for a second cut, although Goldman does think a September cut is likely, so take that for what it's worth. According to a Securities report this week on the same subject, new economic projections showed in their data, in the data released by the Fed, that 15 of the 19 officials expect that there's going to be a rate cut this year, with that group roughly split between 1 or 2 rate cuts. And they go on, they use the median or the midpoint of those projections, which gets them to 1 rate cut. I don't love that. Fed officials meet 4 more times this year, July, September, November, and December. And the rate projections tempered investors' expectations of a September cut. So Strategist does not expect a September cut. So maybe we get one right after the election and then a Christmas bonus of one in December. This dot plot with future projections has been difficult to interpret. They had 4 members showing no rate cuts, all right? 7 of them expect 1 rate cut, and 8, which is a plurality here, expect 2 rate cuts. So I don't love the methodology of just taking the median and go with 1 rate cut. Now, of course, it could swing in the opposite direction from what I'm suggesting here, but you could carve away 1 or 2 of those 7 and get to 9 or 10 that expect 2 cuts this year. Of course, that could be conditioned on a deteriorating economic condition. So 1 to 2 rate cuts. The markets like to use this mean average, but by its nature, the dot plots just move. So 2 is definitely on the table. No promises there. Meanwhile, since we're all talking about AI all the time, it's really part of every conversation. And some folks are thinking about how AI, artificial intelligence, how it's ultimately going to affect the workforce and its impact on jobs. Well then, since we're talking about inflation and rates, at the rate that it's going, AI may be present soon enough in a meaningful way to have a real impact on our low level of unemployment, on our lack of labor. In other words, AI itself might be part of the cure for the developed markets inflation sooner than later, because this isn't something that we're projecting decades from now. We're already seeing it impact some companies in terms of, unfortunately for them, replacing existing employees and certainly curtailing the need for additional employees. And a natural conclusion to this will be, and this isn't just on the horizon, but at no more than around the corner, with both political parties now, both primary political parties, whatever we want to call them, seeming to be moving away from free market theory and towards what they can call protectionism, neoliberalism, or whatever, we're not really going to be prepared as consumers to pay for goods made in a labor-intensive industry. We're not going to do well paying for those goods if the cost of labor is suddenly 400 to 500% higher. So the conclusion of any successful attempts at bringing the production home, reshoring our production, will have to be vastly increased automation, and that will include the application of AI. And this definitely isn't a show about hyping AI. I've made it a point of at least trying to reel in that hype a few times on the show. For what it's worth, though, my AI driver, that golf club that I keep referring to, well, that's been failing me on the course lately, but I do want to make and take a balanced approach here. And I want to temper the most crowded trade in history. A trade which in some respects does resemble the late 90s dot-com boom, as was discussed in the Wall Street Journal this past week, but doesn't have the same degree of overvaluation nor the smokescreen of sources of revenue. This time, the hype is real in that it is transforming the economy already, and there's a tidal wave, a wave that will increase production, it's going to drop costs, and bring higher levels of efficiency in many areas, all with less labor requirements. But also a heck of a lot of that is also being applied to the prices of at least a good handful of companies on the forefront of this transformation. With that, I'm going to take a really quick break here. And when I come back, an update on one of those companies that's in the bullseye of this transformation. For the Wise Investors Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. I'm Simon Hamilton, Managing Director and Portfolio Manager with the Wise Investor Group of Raymond James. Every week, we discuss the latest financial trends and what investors need to know. To learn more about where to find the best future opportunities and how to become a better informed wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Circling right back to that theme of AI and what's working, as the average stock in the S&P 500 actually isn't doing well this year. But anything that says AI is working. And while I'm cautiously supportive of those names who are producing results from the demand in that space, the launch of this massive infrastructure, I'm cautious about valuations. I am a bit worried about how many companies are throwing around and attaching themselves to the term AI. We actually bought a company recently who I'm not naming as a name. Obviously, we therefore favor the company because we bought it. And I'm not getting into the specifics on them today. We think they fundamentally are on solid ground and it was at a good entry point. But even with them, my reason for going slow measuring it a few times, really kind of taking a cautious approach because I was kind of turned off in a way. I mean, there was one attractive element of it, but they put the term and emphasis on AI so front and center on their quarterly calls, on their analyst updates, on their slide decks. That gave me reason for pause. It's certainly at least partially true, but the emphasis is part of what's in vogue today. So watch out for today's version of Beanie Babies. If a company's talking about the biggest themes of the year, well, then it's following trend. And it's a trend that might make them a lot of money, but when everyone's doing it, some of them are, what did Buffett say? Not wearing swim trunks in the high tide or something along those lines. But with all of that being said, I am going to quickly give another short update on Broadcom, which I know Simon just hit on a week ago, but there was a bit more hype this week in news, so I want to circle back yet again. And it doesn't go, but it should be without saying that I own the stock, we own this one for clients, so it's in my personal interest that the stock does well, that it goes up. I am biased towards the stock, and I'll try to give a little bit of a downside risk point if I see one, but let's see. Anyway, Broadcom, symbol AVGO, once was this backdoor investment in Apple, basically, right? If you coveted Apple, well, Broadcom was a kind of a cheaper way to invest in that phenomenon as ubiquitous iPhones took over, as Broadcom was selling some of the guts of the iPhone. And it always, back then, this is not that long ago, this is 5-6 plus years ago, traded at a pretty low multiple, at times single digit to very low double digit multiples, and paid a big dividend. And I'm racing here, I'm summarizing because you've heard this story bunches of times, maybe even last weekend. But Broadcom went on and they started to diversify their chip business to cover other areas of demand for semiconductors, notably including what's needed in data centers. And the Internet of Things became a thing. I don't know if that's truly a thing, but that was a big program. Then they went on and they brought Computer Associates. Nice company. It was supposed to be kind of a free cash flow cow. Wasn't supposed to grow very much, but it actually started growing as the demand for data center management skyrocketed. And that made their data center business bigger and bigger. And then they more recently bought VMware, which they bought in just 2023, last year, for about $70 billion. And that gave them an even bigger software foothold into the cloud computing space. And today, they're providing chipsets and the software packages to manage just massive amounts of data. And that's a big part of what's driving the build-out in artificial intelligence. And they're now at a point where software is about 40% of their sales. And it's now exceeding 50% of their bottom line earnings. Software licensing garners higher multiples traditionally than selling hardware, if not chips. But since chips are so in fashion right now, they're both killing it. Chips, I think, are having best year that I can remember. That's not a stat I can quote, but certainly all the semiconductor companies are generally, very generally, there are some notable dogs, but chips are generally doing well this year. And it looks like chips may have enough of a tailwind to again be over half of the earnings in the near future for Broadcom, not because their software business is slowing or even the growth is slowing, but because there's expectation in the forward guidance that because of the renewal cycle, also due to the iPhone, that there's going to be a big surge in demand for chips from them as well. So both are doing well. As such, according to FactSet, Broadcom today trading at 36 times the forward consensus earnings estimate. And with that appreciation, the dividend yield now is just over 1%. Because the stock is up 55% for the year. It's up 210% since the beginning of last year. And it's up 30% so far in June. And according to a very recent Goldman Sachs report on it, in reaction to the quarterly results, Broadcom, their AI, just the AI business, the AI semiconductor-related revenue was up 300% year over year, which, I don't know if we were talking that much about AI last year. Some, not like now. So it's not surprising to see it surge, but 20% higher than the forecasted revenue they expected there. Goldman, refer to Broadcom, therefore, as a, quote, key enabler within the context of the ongoing build-out of Gen AI infrastructure end quote. And because its near future is paired with a bottom of the cycle non-AI semiconductor revenue, Goldman reiterated their buy rating and an $1,850 a share price target. This is before a split that's coming up, but only 8% above where it was trading today when I went into the recording studio. It's a tough space and it's tough to talk about because the impact is real and can't be wholly understood. It might even be far greater than we now know. The demand for it is just in the early innings and absolutely taken off. And there is a real risk of a disappointment. What can go wrong with AI from a business perspective? Well, we could have increased export controls. There's already some robust ones there and the chance for more. Or maybe just a larger legislative crackdown on how AI itself is employed and deployed. But ultimately, it does really look transformational, which is, it's a nice word to use, transformational, but that doesn't mean it's changing things for the better. It does mean it's probably driving a lot of revenue in one direction. It's probably not better if it's taking your job, or maybe if you're selling discretionary goods to the person whose job was taken by it either. But in a sense, it could solve a lot of problems, and we don't need to talk about that today. You could pick up any paper, and you'll find out how it's going to cure all kinds of diseases and make sure that you always pull up to a green light when you're driving, I guess. Today's concern as an investor, though, it has to be how it's on everyone's mind, how it's part of every investment conversation, and how far these stocks have come recently. So if you've missed out, right, you've done nothing but buy soap and you've missed out on any company related to cloud, AI, whatever, there are still ways to participate. You can nibble here and there and probably reduce risk through various methodologies, which we could always talk about. But if you've been in it, just please don't crowd surf the mob and think these stocks will never stop going up and keep adding more and more and more to them. Instead, for what most people have out there, reflect on your portfolio and think about how much exposure you have to any given stock or to a basket of stocks that can be tied together to this wave. And think about taking some gains. It's not easy to do, but if it's an irrational portion of your portfolio, happily take some gains and look forward to wishing you hadn't if the stocks keep going up in the near term. You won't be disappointed. Maybe you will, but it's a safer approach. All right, that's all I have for you this week. I'm heading back out into the heat, so wish me luck. I appreciate that you're taking the time to listen in. For the Wise Investor Show, I'm Chase Hinderstein.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.